Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we are going to be analyzing SBUX stock. This one came in by request from several people, but more recently over in Patreon someone asked me about it. So I bumped it to the top of the priority list to make a video. You can join the Patreon for free now, the Cyclical Investors Club Patreon for free. And then there's a $5 membership also, where if you want to request stocks that are not in the S&P 500, I don't usually post those on YouTube for free. So if it's SBUX isn't S&P 500, so I'm going to put this video out for everybody. But if you have a request for a stock that's not in the S&P 500, that $5 membership level over on Patreon will get you an analysis from me. And then you can also get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And I'll have all that information over on Patreon if you ever decide to join up there. Okay, as always, this is not individual investing advice. This is just how I analyze stocks. And then if you do request a stock that's in the S&P 500, I'll put it on this whiteboard behind me. I still have quite a few to get through. And if it's in the S&P 500, I'll put it out for free on YouTube. So feel free to request all those down in the comments section, even if you're not over on Patreon. Okay. So I like to start, because I use an original strategy and technique. All of my techniques that I use are original. Now, obviously, parts of them I learned from all kinds of other people and places, but you're not going to find people doing things the exact same way that I am. And so I've always tried, because of that, people aren't always familiar with what it is exactly that I'm doing when I go to try to analyze a stock. And so since I've been doing this since 2015, almost about 9 years now, I do have a track record of sorts, so I can go back and say and show sometimes, and I'm going to do that with a stock like SBUX, kind of this is how this technique has worked out over time. And then people can get an idea of, and I do this with the ones that I'm wrong about as well. I think I did one on Palo Alto Networks here, which was a sell that I just have gotten totally wrong in the past year or so. And usually my stuff tries to predict things 2 to 5 years in the future, so that one's not completely played out yet. But if someone requests something and it's something I was wrong on, I will definitely tell everybody that it's one that I got wrong. And there's more of them too. That one just immediately came to mind because it's up 80 or 90% since then. So with SBUX, let's start with that. Let's go back and, well, the main thing, before we do that real quick, I want to show one of the dangers. I'm one of the few people that are going to tell people when things are really overvalued. And if you go back to 2015 with SBUX, and I do this even with businesses that are high quality. So this is a very difficult thing to do as an analyst, is to say, this is a great business, but people are just paying too much money for this stock. And in order to understand that, you have to go do the valuation work, right? Or understand the risks if it's like a recession risk or something like that. So if you just go back to SBUX, which has always been a great business, to 2015, it was trading at, I'm just going to look at the very basic stuff here. It was trading at a 38 PE, which is very high for a fairly mature business at this point, right? So if a person was bearish on it at this point, none of the things with SBUX business were bad. They were all good, but people are just paying too much for it. So what happens in those situations is kind of two things. One, you can lose money. It depends on the business and the macro environment and a lot of things. But two, sometimes you can just get poor returns. So the person that bought this stock wouldn't have suffered particularly badly during this time. I don't think there was ever a 50% drawdown or maybe even a 40%. Not from that time period. Maybe if you got right down here. No, even then, that's not much of a drawdown. So it wasn't scary to own. But when you only get a 5.85% annual CAGR over 10 years almost, and inflation is 3%, you're only getting, we'll call it like a 3% annual real return. So, and it doesn't seem that bad for some people. I would say it's more like people just sometimes don't notice it. They don't notice how mediocre and poor really those returns are. They didn't lose money. They didn't even lose money in real terms, but they didn't do very well. Okay. So that's one of the big dangers of just paying too much for the stock. Now, I first wrote on this for Seeking Alpha right about here. It was under $50 a share. It had kind of gone through this period of multiple compression where it was 38 PE, and when I wrote about it, and basically what I did was I was sharing when I would buy the stock. And I'll pull that up so you guys can see when to catch this falling knife. Starbucks was like diving pretty deeply that summer. And so I wrote this article. I would say I don't think it's one of the best articles that I hit. I don't think my particular analysis of Starbucks was the best analysis at that time. I think I've gotten a little bit better since then. But the price that I shared was $42 a share, where I was like, this is probably a good spot to buy. That was written on a day when the stock was trading at about $48 a share, maybe 50, maybe it might have been in the 50s by the time I got it. It took me a while to get it published, like a couple days. So on the day that it actually came out and was published, or maybe the day afterward, Bill Ackman, the well-known hedge fund manager, it came out that he had been buying the stock. And so before it got down to my $42 that I was going to buy it at, the stock price immediately rose, and it basically never looked back, right? All the way up here. Let's just see what it was. So all the way up to, it rose 100%. All right. So these are the things that kind of you just have to deal with sometimes. Because I honestly think that news item really did put a floor under the stock because it was falling, and I would have at least gotten close to being able to get it down there. So in that case, the news, which had nothing to do with the business, generated the stock to rise pretty much, and then it never came back down. So those kind of things can happen sometime, but generally speaking, I mean, I was pretty close. And I don't try to pick, like, I'm not making predictions that, oh, the stock will definitely go here. It's really, is there a decent chance it could hit this price? And if it does, this is when I'm willing to buy it. And now, obviously, some stocks have to get to your buy prices or you don't get a chance to invest, right? So they can't be ridiculously low. But you can kind of look back and make judgments and say, look, was I relatively close? And on this one, that would be one I would say, yeah, I was relatively close, but it didn't get there. And I actually had a reason on this one why it might not have gotten there, which was annoying. So on September 16th, 2019, I put out an article that was a legit sell article, like sell on overvaluation. It would have been similar to back here, right? So September 19th, 2019, that's exact day, 32 PE. This was a more typical analysis you're going to see me do here on the channel that I did in 2019, a little bit different than 2018. And it was just sell on valuation. That ended up being, a good call. So not only did it fall because of COVID, which I wrote another article there, but the returns since then have been basically flat, below inflation. I mean, inflation's been like 4% over this period, and it only returned 1%. So negative real returns. That includes the dividend. If you don't include the dividend, the stock is basically, we'll call it just flat. So in my view, that was a good call. So, and again, it'll be based on the valuation I'm going to show you, very similar one. And then during the decline on the 14th of March, or was it the 6th? Let me go check the date so I don't have it wrong. 14th of March is when it came out. So right here, I wrote an article where I talked about my previous stuff like I'm doing now, and then I was like, here's the price that is probably a good time to start buying. I said in between 50 and 60% off its high, and the stock had a high price of almost $100. It bottomed just over 50, so it had a 49% decline. So that's how close again that it got, like within 1%. Like If it would have fallen another dollar, it would have been in that 50% range. I don't remember my actual buy price, if it was more like 50% or 60% back then, because things are moving so fastly. It doesn't stand out to me as one I almost bought, so maybe I was looking for more like 60% at the time. But in my article, I said 50 to 60%, and it bottomed right above that. So it's not that I don't want to buy the stock. It's that it's been pretty overvalued a lot of this time in the periods that has kind of gotten close to being a good bet. It hasn't quite gotten as low as I would like to see it, right? So that brings us to today. I haven't written, I don't think, or made any videos on Starbucks since that March 2021, 4 years ago. So now I'm going to, the way that I'm going to analyze Starbucks is an earnings-based analysis. So they did have this big drawdown, but this isn't due to like cyclicality. So if you look at my other videos, I will look at these earnings drawdowns and base the cyclicality on that. But we know this is all because of COVID, right? So what I'm going to do in this analysis is just take this year out completely and pretend that it's not there, because you don't expect that to happen again, right? So that's one thing to point out. So if you take that out, earnings are steadily, I'll take a bigger picture. Earnings they did decline a little bit during the Great Recession, right? But for the most part, a nice steady rise in earnings if we just ignore this COVID kind of craziness here. So that makes it relatively easy to analyze, but there are a couple things that you're going to want to, I can't remember the time, I think I did 2015, yeah. So 2015 to 2024 is the time frame that I'm going to use. And what I want to do is figure out what the earnings yield is, adjust that for any debt that they might have, and then figure out what earnings growth might be. So if I have those three things, I can see, okay, if you owned this business, how much money would you probably collect over the next 10 years, and what kind of return would that work out to, based on 2015 to 2024 minus 2020, basically. So that's what this whole kind of process is about, and then we can decide whether that's going to be a good return or something we find attractive or not. So I have a spreadsheet that's set up to calculate some of these things. Now, let's start with the earnings growth, because there's some things that I control for my earnings growth rate that a lot of people do not control for. Let's look at fast graphs first. I actually don't know what theirs is going to say. If you shorten the time frame to the time frame we're actually looking at, fast graphs does a point-to-point estimate from here to here, or a calculation, and then just assumes smooth earnings growth this whole time, right? It's basically what it does. So it's looking at almost a 12% earnings growth rate during this time. Now you'll notice mine is more like under 10, 9.75. So the reason for that is I control for stock buybacks, and Starbucks has bought back a lot of stock during this time. They bought back about 25% of the company since 2015. So what that does is, if you're using earnings per share, which is an easy and good metric to use, when they reduce their shares by buying them, it inflates the earnings per share because there's fewer shares available. So their real earnings growth, if they didn't buy back shares, is actually going to be lower than what the earnings per share shows here and that FastGraphs is estimating, right? So when I control for those, which is 25% is quite big. I mean, there are some companies that have bought back more than that, like Home Depot and Lowe's, but that's a significant buyback. So when I adjust for those, that's how I actually get down to this 9.75% earnings growth rate, okay? So now I have my earnings growth rate. I also want to adjust for any kind of debt that they might have. So the way that I do that is, or any other kind of obligations too, is I look at the difference between the market cap and the total enterprise value, and I see what the percentage difference is between those two. And it's about, the total enterprise value is about, and this will also like take into account cash and some other things too that work in the opposite direction. So if a company had, 50% more debt than the market cap, but it also had 50% more cash than the market cap, then my adjustment would be 0. All right. So this is about 21% more. So what I do is I adjust the stock price up by 21% and pretend it's just trading 21% higher, which would be $105 instead of the $86 that it's at currently. And then I use this to get my earnings yield, which is the PE ratio, the price over earnings inverted. So it's earnings over price. So when I do this earnings yield, it'll be earnings over the debt adjusted price, basically. And it comes out to 3.86%. So once we have that, what we need to do is think about, okay, I'm going to buy Starbucks. I'm just going to buy the whole business for like $100, or whatever fraction of the business for. But you get to keep all the earnings on your $100. And the first year, Starbucks earns $3.86 because the earnings yield's 3.86%. So, and then if there wasn't earnings growth, then the next year you would earn another $3.86, and the next year you'd earn another $3. But since earnings are growing at almost 10%, we want to include that. And what I want to know is how much money on my $100 investment could I collect in 10 years using this method? And I pull forward the first year's earnings growth. So that's what this is meant to calculate here. So when you get up to 10 years, your $100 would be almost $167. And I want to know, okay, what kind of CAGR is that? What sort of annualized compounded return is that? And it's 5.25% per year. So how does that stack up against alternative investments? Well, cash earns about 5.3% right now, like short-term treasuries, which is what I have a lot of. So its 10-year return is likely to be 5.25%. Now, I would say if we have higher than expected inflation, Starbucks will probably be able to pass that inflation on because it's a high-quality business. Whereas if you're just sitting in cash, you are not going. You're going to be dependent on the Federal Reserve to raise interest rates if inflation stays high. Which usually it can be lumpy, but usually they have to do that if that's really the case. But inherently, especially because I'm on the short term of like cash / treasuries, if you went out to the 10-year, and I know it's trading up farther up now, maybe I don't know, it was like 4.3 to 4.5 or something like that. I haven't looked at it for a few days, and I know it's been going up. You would not be able to pass on in future inflation on that rate. So if we have 3% inflation in the next 10 years, and you're only earning 4.5%, but Starbucks can pass more of that on. Remember, we didn't have any much inflation from 2015 to 2020. So this earnings growth rate is going to be a little slower than it might in a bigger inflationary environment. So Starbucks has the advantage there, I think, if there's more inflation, especially if somebody goes on the long end. But I just want to make sure I'm not most people are going to compare this to the 10-year treasury bond or maybe corporate bonds. I don't do that. I look at, if you do that, you need to keep in mind that Starbucks can raise its prices and a treasury on bond in 10 years cannot. So that would make Starbucks more attractive compared to that. I think long-term fixed bond rates are bad right now. So I would definitely take Starbucks at this price over them any day. The bad news is if there's a bad recession, then Starbucks can come in weaker while those bond yields will remain the same. Okay? But compared to the rest of the market, this is basically where the S&P 500's at. Starbucks is trading about where I see almost everything else at, in between like 5.25 to 5.75, using my methods or whatever, which again are just estimates. So, there's a range. This is what I'm seeing most S&P 500 stocks trading at in terms of valuation. So compared to the S&P 500, it's basically in line with everything else. I don't think it's any cheaper or more expensive. In terms of where I would buy it, now if we just take recession off the table, remember when I calculated this there was no recession. The one recession there was, I took out, right? So they could, and if we look at, I mean, they're bigger now. I think a recession would hurt more than it did back in 2008 for Starbucks because they were smaller. But they did still have earnings fall 18%. So we know they're economically sensitive. And that would lower this earnings growth rate. If there was 1 year that was down like 20%, this earnings growth rate might only be 8% if I take that into account. I think I only had 1 year that was like 9% that I took into account, which was this 2022 maybe. Yeah. So I did take this drawdown into account, but it'll be much deeper if there's a real recession. That was earnings drawdown, not price drawdown. So for me, I like to have this be 8%, the return CAGR be 8%, to try to get good returns. This would have like a margin of safety, aim for bigger returns, so on and so on. That's about $50. I think it was exactly $50. 6.5% is kind of fair value, so you can kind of figure, that's, yeah, you're well, I can test it real quick. 86. I'll show you. We'll figure out where midpoint of fair value is for everybody. So it's not there yet. Almost. Yeah, about 60. Whoops. About $66 per share would be what I would consider the midpoint of fair value. So we were at 86. Now, if we have a recession, it can fall deeper. I'm not going to go into that because this is already like a long video, but probably 56 more. This is again with a margin of safety and all that. It could definitely get cheap. It could definitely get cheaper in that situation. So there is potential downside still at this price if we have a bad recession. Okay, hopefully that helps everybody. Again, I hit the YouTube subscribe button if you haven't done that already. And I also have a 25% off affiliate link down in the description for fast graphs, which is what I was using here. So if you thought this was potentially pretty useful, it's really not too expensive for the basic version. And that can help out the channel here a little bit too. If you are already a member of Fast Graphs, I don't think that discount works. So it would just be for new people who haven't used Fast Graphs before, but definitely check that out. And if you have any requests, put them down in the comments section. I'll get those tickers on the whiteboard behind me, and I will eventually make a video for you. All right, thanks a lot. See everybody later.